Good afternoon, everybody. Just going to wait a few seconds just as people join. As the numbers start to grow, I can see that. So, yeah, let's start. Good afternoon, everyone. My name is Paul Fenner. I head up the construction nationally for BDO. I'm joined today by two of my colleagues, Ollie Back and Lee Causer, and it gives me absolutely fantastic to see that we've got our special guest, Philippa Spence, from CEO of Ramboll.
MD. My CEO would be my subsidiary.
Oh, sorry, MD of Ramboll, who we're fortunate enough for her to give her personal viewpoints on the sector. The agenda is actually short. It's 4 presentations, and we'll have a Q&A session at the end. We're going to try and wrap up within the hour. So a quick few housekeeping points, as usual, on these things. Today's webinar will be recorded. We will circulate the recording and the slides, and we're also looking to produce a report at the end of the month on construction and the survey results. Please submit questions if you have any using the Q&A chat function, and if you have any problems technically, please also submit that through the Q&A function. So next slide, please. Next slide. So I wanted to give a quick economics update on the state of the construction sector. It's one of the largest, and it's a barometer to other sectors. Construction accounts for 7% of GDP, 10% of the workforce. That's 3 million people working in the industry. Overall, in terms of overall, not just construction, but overall, the economy is slowed in the month of April. So in March, it was 60.9. And it's dropped down to 57.6. So just to explain what that means, anything above 50 represents growth, anything below 50 represents decline. So actually, we're still in growth, albeit slow, but it's really a noticeable sudden drop in April. And I think primarily the reasons for that are the increased cost of living, energy prices soaring, raw material price inflation and material shortages, China gone into lockdown, and the Ukraine war causing prices to increase even further. So the outlook, it's one of uncertainty because nobody knows when these prices will stop rising. In addition to this, there were a number of companies that actually were protected during COVID by government subsidies, furlough, for instance, and also the CBIL loans and tax deferrals, which they all now need to be repaid. All of that escalates and adds to the problem. So in February, it actually dropped, the output dropped by 0.1%, but actually as a sector overall, we've got back to pre-pandemic levels. It's actually up, it's 1.1% up February 22 compared to February 20. So that's actually good news, but it's a mixed bag of performance in the subsectors of construction. So infrastructure, for instance, you can see on the bottom there, 25% growth from February 20 to February 22. That's an incredible rate of growth, but largely off the back of Boris's Build campaign, overseas investments, and HS2 motorways and roads to help this growth. Next slide, please. So other areas where there's been growth, private housing, that increased 3.6%, and I think that's largely off the back of stamp duty initiatives. Repair and maintenance has really done well, but in certain areas. So private housing and non-housing repair and maintenance has gone up, whereas there's actually been a fall in public sector housing repair and maintenance. Warehouses and distribution and logistics, again, well reported that they have performed exceptionally well, primarily off the back of internet sales during COVID and the retail sector struggling. And we've got losers such as private commercial office builds, so particularly in London, there's been a slump in office build. The biggest winners, supermarkets, healthcare, logistics. The biggest losers in construction, retail, aviation, leisure and hospitality, pretty much around the sectors that you'd expect. There's also been a lot of activity, M&A activity, and PE houses who have invested huge amounts of money in the sector, but they are particularly concentrating on where there's innovation and technologies, green or modular. Next slide, please. What I've put here is a V-shaped curve, which I'm sure you're all familiar with, the drop-off during March and April 2020 COVID lockdown. But the recovery you can see is pretty much back to pre-pandemic levels. It grew pretty much from June 21 at a good rate, and it's now 1.1%, as I said earlier, at February 22. The next slide just shows you that in a bit more detail in just the actual pre-pandemic and post-pandemic levels. Next slide, please. That looks a busy slide, apologies, but you'll get copies of these slides. But what you can clearly see is the top line, the blue line, is infrastructure, way ahead of where it was back in 2020. So is private housing. All the others are pretty much level or just slightly below. Next slide, please. I'm not going to spend too long on this. Clearly, you can't have an economic update without talking about the issues that are facing the industry in terms of supply chain and rising prices. But I'm going to leave this to Lee and Ollie to talk about in more detail. Some of the key concerns facing the sector are the resilience of the supply chain and the shortage of material and price inflation. And it's obviously well documented about this, but I wanted to concentrate on the general price rise. That the output price index at February was 7%. And that's actually one of the highest rates it's been since recordings back in 2014, I think it was. So these costs are really driven by the cost of steel, concrete, timber and glass. And they've significantly increased, where what's concerning is in a number of cases, these can't be passed on to customer, particularly on fixed rate contracts. What we're seeing is there are a number of multiple price escalators now being factored into contracts. What we're also seeing is a number of businesses are now working on just-in-time basis. They're no longer working on just-in-time basis, they're working on just-in-case basis. And that is because they're stockpiling, they can't afford to stop production, so they need to stockpile certain materials. And that obviously absorbs a lot of cash and working capital now being held as stock. So one of the stats on there is 27% of businesses had to change from their normal supplier to a new supplier, alternative supplier. And actually of that, 10% of that new supply chain was outside the UK. Coupled with this, there's reverse domestic charge. There's been issues where a number of subcontractors have now been faced with potentially losing 20% of their working capital overnight. It's quite a lot of things happening in the sector in respect of prices and supply chain. Next slide, please. This shows the output price index, and it shows you clearly it's going one way. It seems to be going up, and as I said earlier, nobody knows really where it's going to end. Next few slides are really around our survey that we carried out in January, February earlier this year. We had a really good spread of construction companies across all subsectors, and both private and public sector across Britain. 90% of those that responded actually said that they were positive about the outlook for 22 and 23, particularly in terms of orders, headcount and profitability. That's a massive percentage, of which of that 28% were really positive, very positive about it. But again, I look at that and I'm not surprised at all, because typically secured order books run for 2 to 3 years out. So the key issue is what happens after that period. We asked a number of you about the key challenges you faced in 2022 and beyond. 75% of you responded skills gap, which isn't again a surprise, but you had difficulties recruiting, attracting and retaining good people. And the workforce in many cases is aging, and succession planning is still a key challenge. 50% of you said that supply chain was still a concern, and 16% of that number said you were extremely worried by the supply chain resilience. Interestingly, last year when we did the same survey, we actually had working capital and contractual disputes, which were high on the list. And I suspect that was primarily because of the COVID impact and delays on contracts, and that caused a number of disputes. So why it's so low now, it's a little bit of a surprise. Next slide, please. Areas where you felt you needed to improve confidence in the sector were innovation and technology, R&D. And we've seen in R&D that there's always been a low uptake for construction compared to other sectors such as manufacturing. Not entirely sure why, but it does seem to be a low uptake. I think it's about 2.5% of all claims made in R&D are only made by construction companies. There's a need to improve skills through training, multi-skilling, more apprenticeship schemes. The workforce is also becoming, to make sure that the workforce becomes more efficient. And we're also seeing that it's good to attract talent, and you're talking to educators and colleges and schools. Next slide, please. I'm going to rattle through some of these. So areas to invest. BIM, meaningful management information, and the reason for that is to understand where high margin and profitable work is. New premises are on there, and I suspect that's to do with working from home and hybrid approach to working and downsizing potential buildings or putting more tech into those buildings. So that's a new one this year added in as areas to invest. Subsectors doing well, as you'd expect. So they're on the screen. Next slide. So this is my last slide, and I just wanted to point out that climate change is really key. 65% of you who responded to the survey said you'd got plans in place to focus on low carbon solutions and reducing waste. COP26, which we had in November, clearly was something where we all understood that we needed to do something about reducing carbon to save our planet. However, material costs and other costs of living, energy prices, and all these things I mentioned earlier, these are concerns that this requires a significant amount of investment in and funding, which is difficult, particularly as you may be in survival mode. The problem is, can you afford not to invest? As if your competitors are greener than you, you potentially will lose revenues, and that's something to watch out for. And I'm sure Philippa, who is next to me, will take you through in her presentation. Over to you, Philippa.
Brilliant. Thank you so much. Thanks, Paul, and thank you very much for inviting me to speak. So if we go to the next one, just a little bit about Ramboll. We're an international company. We are multidisciplinary engineering, architecture and sustainability consultancy. And, we, like everyone, are experiencing the challenges of balancing the short term with the long term. And effectively, that is really what we're trying to do in making decisions around ESG versus some of the short-term pains that you've just shared. I think what I'm going to talk about today is what I really believe very strongly is the fact that we have to do more in terms of ESG in the construction sector. We are in my view, the foothills of major and rapid transformation driven by the need to operate and construct more sustainably. And I'm going to explain why. I think if we start at the fact that we're in the decade that counts, we're 2 years into the decade that counts in terms of trying to keep global warming to 1.5 degrees above pre-industrial levels. There's an awful lot to do, and the construction sector in particular has the opportunity to do a lot, but it's not easy. I think there's two things we really have to focus on. One is that ambition, the 1.5 degree ambition. The other is just the fact that we actually have to design and construct for resilience, because climate change is now inevitable. We see that all over. And so we have to consider that. And that is itself a fundamental change. The other reality is that financiers, regulators, shareholders, investors are absolutely asking more when it comes to ESG. And that is because they're worried about the return on their investments. So that is absolutely central. So the landscape has fundamentally changed, and it's harder to access finance. It's harder to reassure investors, and it's hard to protect reputation if we cannot show evidence-based commitments to ESG. Let me talk about that a little. If you put them all 3 points on. Just a brief reflection on the survey results. I guess the first piece was my surprise. Surprise that 23% of respondents felt that sustainability was not a focus. And as I talk through, I'll try and explain why that surprised me. I did absolutely agree with the priorities many shared. 70% felt that a priority was committing to low carbon efficient solutions, 50% around reducing waste. Totally agree with that. And in terms of barriers, I guess I was surprised at 31% saying that one of the barriers was innovation on new technologies. To me, that's an opportunity. Actually, equally, you could say the sustainable renewable materials. There is opportunity there as much as there is risk. And that's the way I would like, that's the lens, if you like, that I think we need to see ESG in. So if we move on, there's a huge opportunity around this, and I'm going to just share 3 points around it. The UK made a 38 billion commitment in short-term social and economic projects around transforming infrastructure through the roadmap to 2030. So that's the short-term financial commitments. There's 100 billion in the longer term through the National Infrastructure Strategy. But all of that comes with world-leading, but really increasingly stringent expectations around ESG. And then there's, of course, the 90 billion that is intended to be unlocked in the private sector through the seminal piece of work, the net zero strategy to build back greener. That's huge. It's really huge. But all of that really comes with these much more stringent expectations. So let's have a look at those. Now, a lot of you won't be able to read all the detail on this. You don't have to, but it helps me to talk you through why I believe there's such a fundamental shift that we're in the middle of. So from 2017, the government started making major changes around their strategic view of sustainability with the Clean Growth Strategy. And the Clean Growth Strategy was all about growing our national income while cutting greenhouse gas emissions. Then came in 2018, the 25-year Environment Plan, another seminal piece, which tightened up expectations. Then we get to 2020, and you really start to see this ramping up. 10-point plan for the Green Industrial Revolution. You've got the Energy White Paper, which talks about transition to renewables. You've got the Construction Playbook, which has huge sections dedicated to what does net zero expectations. And then, of course, we hit 2021, driven, yes, by COP26. We've got the outcomes there, and I won't go through all of this, but you can see just in terms of the number of strategies, plans, and regulation that's coming around sustainability. Everything from the net zero strategy all the way through to the transport decarbonisation plan, Construct Zero, the energy security strategy. All of those have really major ambitions around sustainability and ESG. And then on the right-hand side, you can see I've pulled out some of the implications of that will change our sector. And we need to be ready for that. We need to be future-proofing for that. But in fact, we're in it. So that is why, for me, I don't think I can deliver on my fiduciary duties as a director and managing director of Ramboll UK without having this in mind and without shaping the business towards it. If we move on, here's something that really matters to all of us. The Environment Act, which came in towards the end of 2021, is the biggest piece of environmental legislation since the creation of the Environment Agency. It's huge. Well, it's huge in many ways, 264 pages, 149 clauses, 21 schedules, all of which contain changes which we have to understand and respond to. Just to give you a bit of a sense of what that actually means, if we go to the next slide, let's just take a mixed resi development. I'm just going to pull out a few examples. Going forward, a mixed resi development will need to achieve biodiversity net gain. So that means that it's got to go beyond just meeting no net loss. It's actually got to improve what was there on the site before. That means that along with the usual planning application, we also have to submit a biodiversity gain plan, which also has to have approval. And if it's not achievable to do that on site, we have to look at off-site enhancements. There's also a real focus on reuse of buildings, circularity, and really looking at ways to minimize waste and preferably to recycle that. And that requires designing in a different way. To move forward and we start thinking, I've talked to you through some of the regulatory changes, and I've really just touched on a bit there. There's a lot more. I want you to talk about the financial institutions that actually invest in major development. And what we're seeing there is a move from the aspirational, which you can see with the PRI in 2005, which started really setting some expectations, some parameters, some ambition around what to expect. Sorry, that's the UN Principles for Responsible Investment. Then you've got the FSB being set up in 2009, and what came out, and they realized they had to start putting again some parameters, some clarifications around what ESG actually means, so that they could track it, so that it could be monitored, so that it could be governed. And they were the ones who came up then with the Task Force for Climate-Related Financial Disclosures. It's a heck of a mouthful, but it's got an awful lot within it. That really is saying to businesses, you need to start being transparent and disclosing your risks and the opportunities associated with climate change. And that happened in 2015. In the UK, by 2023, so around the corner, many of us will have to, as a matter of law and regulation, actually disclose in accordance with TCFD. What's coming next then is the Task Force for Nature-Based Financial Disclosures. So that's then giving the same degree of transparency around biodiversity impacts, biodiversity risks, and biodiversity opportunities. And that came in 2020. And what I'm showing you essentially is going from a very broad funnel down to much more tightening of expectations, a codification of it that also goes from soft law into regulation. And that's what I've got on the right-hand side there. I started with the Sustainable Finance Disclosure Regulation, which is really looking at trying to allow for comparability between sustainable disclosures and also requiring regulating them. And we have left the EU, but we will be matching and mirroring, in many instances, that regulation. And with that, we're going to be getting the sustainability disclosure requirements. So that's the UK equivalent, if you like. And then we've got the EU taxonomy. That is an absolute game changer. That is codification like we've never seen it before. What it does is it actually says what green looks like. What are the specifics, which mean a building is green, a development or technology is green, and that will drive financial institutions in their decision-making in terms of when they've got to decide whether something is acceptable from an ESG perspective. It is towards the taxonomy that they will look, because it codifies, it makes it simpler. But it also means we've got to meet that challenge. And in the UK, we will have something very similar, which will be the green taxonomy. And there's, that's a point at which it's being defined. So this really matters when it comes to financial institutions. We move on. Financial institutions have also come up with a lot of voluntary initiatives. And I've just got 3 examples, and really there are hundreds. We've got the Climate Action 100, the Institutional Investors Group on Climate Change, and the Global Investor Coalition, all of which are broadly seeking the same sort of thing. And that's trying to make good decisions in terms of investments around those investments that will help, or at least it will help to achieve the 1.5 degree ambition in terms of controlling global warming. So the pressure and the expectation is coming from all over. So what does it actually mean? So let's have a look. There are 4 things essentially in the construction sector. There are increasingly going to be tighter regulations, and I've just shown you one, which is the Environment Act. And so, as soon as regulation comes in, it means that it's a lot clearer what needs to be done. There's an awful lot of secondary regulation that does need to be put in place to actually enact and enable the Environment Act, and that is, in train at the moment, but the direction of travel is clear. You'll also see, I believe, and we're already seeing, more conditional funding. So various funds requiring ESG targets to be met as a condition of finance. Now, there's opportunity as well as risk in that. The opportunity being that sometimes you can actually get, a better rates, a better offer, really, if you can show that you're very much aligned with those ESG expectations. Then there's great opportunity in terms of additional funding for those kinds of developments, technologies, etc., which are aligned with ESG expectations. And then finally, as I say, actually it's the same point really, that there are so many opportunities that need to be grasped in terms of the technology we need to actually achieve the ambition that I've just talked through. We have to invest in R&D. We have to find the route. Not all of it is clear, but we must put effort into this. Which brings me really to my last point, which is why Ramboll has made such a fundamental shift in our new strategy, which is just launched at the beginning of this year, which is, it's called the Partner for Sustainable Change. And if you wanted to put a strapline on it, it would be all in on sustainability. We are shaping our entire business around 4 unifying themes, all of which really lend themselves to what I've talked through: responding to the challenge, responding to the opportunity, and responding to the direction of travel around ESG. And those 4 themes are decarbonising for net zero, so really enabling the transition to green energy, contributing to resilient societies and livability, so infrastructure that is resilient but also actually livable, so a built environment that meets those 2 criteria. Biodiversity and ecosystems, that is a genuine crisis, the speed with which we are losing biodiversity, and so it's actually looking for the solutions that we can actually grow and continue to deliver on the built environment back in a way that isn't as harmful, which brings me to the final point, which is really good resource management and circularity, circular economy. Very challenging because, as I said before, it does require us to actually design and construct in a different way where we can go back and use resources again. So lots of opportunity, lots of challenge, but it's not something we can look away from. To my mind, this is something we've got to deliver in the short term as well as the long term, alongside all the challenges that Paul very rightly pointed out in his presentation. So thank you very much.
Thank you, Philippa. Ollie Back is a partner in our contract and commercial risk services. Over to you, Ollie.
Thanks, Paul, and thanks, Philippa, and good afternoon, everybody. So I think I just wanted to very quickly recap on what some of Paul was saying at the beginning. So if we could maybe just move onto the first slide. You know, it's incredibly obvious to everybody, but we are experiencing a very, very severe and sustained period of disruption, particularly around supply chain and materials and logistics. And actually, over the last couple of years, we ran a webinar around supply chain risk. I think it was a month after lockdown was our first one. We also had one around Brexit, both of which are still, you know, very much impacting the reality on the ground today. Whether that's through the physical flow of goods, obviously China being in additional lockdowns now, that's having a knock-on influence. Also, with regards to Brexit, the friction around ports is still very real, and it's having a significant impact on the sector overall. And then obviously added on top of that, we've got the geopolitical uncertainty, the war in Ukraine, which has obviously shocked everybody and had huge ramifications around supply chains more broadly. And then to add something on top of that, we've now got an inflation level which is at its highest level for 40 years. Actually, a lot of the central banks at the beginning of the year were suggesting that this would be a very transitory period of slight increase in inflation, but actually the reality is that actually it's non-transitory. It's likely to be here for at least the foreseeable future. So again, I think perhaps we'll look back at the end of all of our careers and think actually this period is one of the most significant periods of disruption, and it's a very, very challenging time to be managing a supply chain. Now, obviously, it's an incredibly broad topic, so we can't cover everything, but we've just picked on 3 areas which we're seeing clients currently grappling with, and the first 2 in particular came through very strongly in the survey results, as Paul said. So we'll be covering things around supply and materials costs and availability, resilience through the supply chain, particularly financial resilience of key suppliers, and then finally just around your customer contract performance, but also how your subcontractor agreements are performing as well, as there are areas which you can help improve profitability or cash flow, which in this current period will always be helpful. There's going to be a lot of things within here which Lee will cover with regards to things like materials cost and the impact of the current broader economic situation on business resilience. But I'll just cover it from my particular field, which is effectively supply chain and contract risk. So most of this in terms of managing cost of inflation materials, no doubt all of you will be very aware of some of the tools which a lot of firms within the sectors have been using. So you know, the warehousing cost increases that Paul referenced earlier, very much indicative and a symptom of the uptick in stockpiling that's happened over the last 12, 24 months. So obviously a lot of the bigger firms where cash is more abundant have been using this as a tool to support both the cost and the availability risks of the current environment. Futures contracts has been a tool that's been used for those who are ahead of the inflationary moves. However, now there's limited value in that currently, just given where the futures contracts prices are with regard to materials. So again, that's another lever which some firms have used up to date, but now is becoming less of a valuable tool. I also think it's really important just to mention on the stockpiling point, we have seen a marked shift of using that as a lever geared towards the top end of the market where cash is available. That has actually had knock-on impacts to the smaller and medium end of the sector too. So last week I was having a conversation with the owner of a very small construction firm, and he basically mentioned that he had recently visited a depot of one of his key suppliers, and there were piles of goods with sold stickers on, but actually a lot of the people who had bought them weren't really aware of whether or not they'd be using them, what they'd be using the materials for, and for him and his business that presents a real problem. So again, what have people been doing? Looking into alternative sources of supply, alternative materials is the obvious point. The survey mentioned that 25% of our respondents have, over the last 12 months, had to seek alternative sources of supply as a means to try and combat the cost inflation of materials. So, I mean, beyond those, short of solving the logistical issues and the physical flow of goods, getting inflation back under control, there are limited tools available to remedy this. So therefore, it's looking to other areas which are within your control to try and mitigate and offset some of these negative impacts. The first one, which again perhaps is perhaps a bit obvious, but again it's definitely worth considering if you haven't done already, is just really reiterating and re-establishing where our commercial and cost exposures across all of our contracts. You may not be on uniform T's and C's and commercial mechanisms across the board, so it's well worth just rechecking, which contract portfolio elements have the greatest delay penalties, for example, which ones are we on the hook for delivering costs at fixed prices, for example. And then once you've got a view of that, consider how you might be able to direct your own resources and materials that you do have access to try and optimize your commercial position as a result. I think beyond that, what we are also starting to see is people being a lot more communicative and collaborative across the value chain. So I think BIM investment was mentioned as one of the top 5 areas that people are considering investing in. For those that have BIM at the moment, this is actually quite a useful tool to make sure that people are very aware upfront and communicating what are the critical path stages of the construction itself, who is needed when, what materials are needed when. And so where you get suppliers who are aware of a shortage or a delay in a particular shipment, which might have knock-on effects, people are starting to use technology to get better an early sight of that, just to try and make sure that the whole process is a lot more, or rather as efficient as it can be. So I think that's what I was going to say on cost and availability at this point. The other area, I think 50% of respondents mentioned that supplier resilience was a particular area of concern, with 16% of you saying that you're extremely concerned about this. So again, it's not just about making sure you can get goods at a decent cost, but also get good availability on them. It's understanding of your critical suppliers, how resilient are they as entities. The current environment is putting a huge amount of pressure on businesses across the value chain. So making sure that you are aware of who your critical suppliers are, and more importantly, how robust their financials are and what is their overall level of resilience is really important. So practically speaking, what does that mean? Well, it can mean anything from basic credit checks against your key suppliers, all the way through to doing your own detailed analysis against their financial statements, to pick out particular liquidity indicators, Z scores, M scores, and things like that, just to give you advanced sight over which ones might be in financial distress. And then you can obviously update your business continuity plans to make sure that you're looking for alternative sources of supply if necessary. I think another more commercial relationship-based point here, which is really important, is making sure you're aware of what your position is in the supplier's eyes. So separate sector, but I was having a conversation with the chief exec of an engineering firm fairly recently, and he was really concerned about where his organization ranked with his semiconductor suppliers. He wasn't really sure, actually, we give them a huge amount of business, but actually, where do we rank? Are we actually going to be the first ones in line, or are we going to be back in the queue? So getting a sense of where you are on that scale is also very, very important. So overall here, just make sure you're increasing the transparency over where your suppliers are, whether or not they're potentially in financial distress. And then once you're equipped with that information, you can start to adapt your business continuity planning and your overall sourcing approach. So I think the final area I just wanted to cover, which is slightly separate, but very much linked to this. Obviously, we've been speaking a lot about the overall cost and availability of materials, the resilience of your supply chain. A lot of those will have material impacts on your overall profitability, but actually there are tools outside of that which you can explore, which might help alleviate some of these cash flow pressures which you might be experiencing. And that's really about how well your contracts are performing. So for those of you who have been on one of our previous webinars, I think it was the COVID webinar, we touched upon contract management. And World Contracting and Commerce, who are the industry recognised sector-wide body in this area, have effectively done a lot of research around how how contract management can have an impact on the bottom line. And you can see the stat there that actually getting contract management right can generate a lot of positive upside as well. So it's really worth looking into this. And that's both on your customers' contracts, but also your supplier contracts. So if your customer contracts, do you have a very, very robust view about how effective your EAC planning is? Are they robust? Have they been challenged? Are you in line for any potential EAC shocks later on down the line if they haven't been challenged appropriately? So that's really just making sure you're very, very aware of what the commercial position right now on your contracts is, but also getting a sense of, if there are any further delays or cost escalations, what impact might that have on our overall customer profitability? And on the flip side of that is how your customer and subcontractor agreements are performing. So obviously a lot of the industry is outsourced to third parties. So who's actually on the hook for delivering and keeping your promises, so to speak? And are they actually delivering in line with their obligations, but more critically, in line with the commercial mechanisms that you have agreed? So making sure that your teams are very, very proactive in managing the supplier contracts is really important, because we often come in and have a look at these types of agreements and see that actually quite a lot of cost and value leaks out of contracts over time. So being proactive on the contract management front is, again, just another area I'd recommend you look into when it comes to just managing your overall commercial performance and cash flow. But I think I'll leave it there, and I'll now hand over to Lee, who will pick up on the managing growth front.
Thanks, Ollie. And so, the subject there is managing growth. And I think to start off, it's really important to recognise that people's definition of the word growth differs. And some will focus on revenue, some will focus on profitability, some will focus on cash. But more and more the conversations that I have with clients, I'm hearing more that businesses are focusing on growing revenue. And when questioned about why, sometimes they struggle to answer that question. It can be a default setting to just try and grow just for the sake of growth. So what I'd like to do on my session is just to try and frame that a little bit, to emphasise some of the risks that occur. And the first area of that is when businesses grow, that is most likely to increase the likelihood of failure. So we have the next slide, please. This first chart is a chart that shows the total number of corporate insolvencies that happen in England and Wales over the course of the last 11 years. And you can see from this that at the outset of, from when the information is available in 2011, it was just over 20,000 corporate insolvencies within England and Wales, which dipped to below 15,000 and stabilised over 15, 16, 17. We then started to see some growth in the number of businesses that were starting to fail. However, when COVID hit, despite there being an initial assumption that it would result in an increase in corporate insolvency, the exact opposite happened. And there was a big drop in 2020. It has recovered slightly in 2021. Next slide, please. Now, to look at the same information, but on a quarterly basis over this period, you can see that the volatility in the line, particularly in terms of the total numbers, so the blue line and the maroon coloured line towards the top. Now, what we saw was a big fall at the outset of COVID. The reasons behind that were purely down to the amount of government measures that were available to businesses to enhance their liquidity, provide some protection and moratorium. Just to try and take out a bit of the volatility there, if we move on to the next slide, this shows the same information but on a rolling 12-month basis. So again, we can see that same sort of profile and drop off that happened, but now it is starting to increase. Now, where that increase is happening is it's not in the administration part of the insolvency market. It's not in the compulsory liquidation, which is where businesses are wound up by the court. It's in the creditors' voluntary liquidation part of the market, and it tends to be smaller businesses within the supply chains. Now, what we're talking here is this is across the entirety of the market, across all sectors. So we'll move on now to look at specifically what's happening with construction. Looking at the total numbers, we can see that on the whole, construction insolvencies have followed the same sort of trend as what we see throughout the UK and across all sectors, in particular with a big drop off when we compare 2019 to 2020. If we move on to the next slide. Now, again, looking at this on a quarterly basis, you can see that it really does follow the same trend as what we can witness throughout the entirety of the UK economy. Same sort of profile, big drop in number in 2020, but we're starting to see a spike throughout 2021, such that the overall number of construction insolvencies were higher in Q4 of 2021 than at any point since 2012. But again, this wasn't administrations, it wasn't businesses that were being wound up by the court. We hear a lot of nervousness about HMRC and how they react to businesses with arrears. But what that isn't translating to is an increase in numbers being formally wound up. This is more discretionary liquidation and businesses that probably would have failed over the previous 2 years, and there's an element of catch-up. Move on to the next slide, and again, this then just shows it again over a rolling 12-month basis, so it's the same sort of profile. Now, with regards to the final chart here, this chart provides an indication of construction insolvencies as a proportion of total insolvency within the UK, or within England and Wales, I should say. And over the course of the last 11 years, it's fluctuated pre-COVID from a high of about 21% to a low of about 16%. Now, during COVID periods, it did drop. It dropped down to about 14% as an overall quantum, but over the course of 2021, it's bounced back to the same sort of level of what we were seeing prior to COVID. Across this entire period of where the information's available, the construction sector has contributed 18% of total corporate insolvencies that have occurred. And throughout this period, which takes in 44 quarters, construction ranked as number 1 for corporate insolvency in 43 of the 44 quarters. So it's always at the top of the league table for risk of failure. Next slide, please. So what's causing this and what's continuing to cause it? There is an element here of a reversion back to the norm. It cannot be escaped the fact that COVID contributed huge security blanket for many businesses that allowed them to mitigate the worst case event of an insolvency. And what we are seeing now is an element of catch-up there on insolvencies that would have happened but didn't. The next quarter statistics are revealed on Thursday, and the general indication is that that trend will continue to have increased as we've moved into 2022. Applying this to our survey, 21.9% of respondents said that they performed worse than expected in 2021. But 67% believe that they'll increase their profitability in 2022. And this is where we start to see a little bit of contradiction in terms of some of the results. We do have demand versus supply issues. This is resulting in price increases that we've seen from some of the charts that have been provided in the previous presentations. But labour shortages are contributing to this, and 75% of respondents are right to be concerned by it. 60% plan to increase headcount, but 70% are struggling to do so. There is a huge skills gap, and the risk for the sector is that this continues to increase the labour cost. Similarly, with material shortages and price inflation, 70% of respondents were concerned about this, and again, rightly so. And around labour, around material, it does need to ask the question of, can these price increases be passed on to customers to the same extent? Or, which is potentially most likely, would it cause margin erosion? Would it cause losses? Ollie's touched on supply chain resilience, and a huge contributing factor to distress within a business can be the failure of a key customer or a key supplier. Checking the financial robustness and stability of key customers and suppliers is absolutely crucial, particularly in a time where life is just so uncertain. Overlaying that with contract delays, contractual disputes, the issues that this causes with working capital management, how does any business reasonably go about preparing forecasts and predicting what the future holds? Really important to consider different scenarios as part of essentially a disaster recovery plan. One of the biggest contributors to failure is overtrading, chasing revenue at the expense of profitability. This is the point that I often get a lot of challenge about from business owners who will say, well, if we don't bolt on revenue, then we're going to fail. If our revenue decreases, how are we ever going to generate profit, generate cash? It's a really fine balance, but it is absolutely crucial to make sure that profitability is at the core. And ultimately, businesses are running out of cash. They're paying back what they owe or have deferred and what they've borrowed over the COVID period, or they have cash that's tied up in its working capital. Ollie touched on stockpiling. Warehouses are full of stock. Converting that stock into cash is incredibly difficult. Next slide, please. So how to mitigate some of these problems. General principles are relatively simple, but shouldn't be underestimated. Pure focus on profitability and cash rather than revenue. If you can get all three, all the better. But it's so important to not underprice just to win work. Doing that, unfortunately, will cause many businesses to face the inevitable, which we do not want to see happen. Ensure that there's proper communication internally. Some of the saddest situations that I've seen in this sector are where businesses have failed because sales have submitted tenders for projects but haven't spoken to purchasing about the cost of the key raw material. It's absolutely crucial to be joined up and communicate internally. Monitor supply chain resilience, consider stability of key customers, and really, again, just focus on revenue is vanity, profit is sanity, and cash is always king. Many businesses can make a profit but lose cash at the same time. If you run out of cash, then you're not going to be in a position to continue to trade. And moreover, seek help, seek advice. There are plenty of advisors out there who do not want to see businesses fail and want to help them thrive and reach out to that network. Accountants, lawyers, absolutely crucial to help businesses with overcoming uncertainty and achieving growth and achieving success.
Thank you, Lee. So that's all the presentations from us. I just took up some points from that. So on the green issue and ESG, obviously we need to start acting now in the next 2 to 3 years in this decade. On Ollie's slide, there was one thing that jumped out at me: poor contract management costs the company the equivalent of 9% of the revenue. And Lee, I can see Lee being very busy over the next couple of years, being in business recovery. But his message is really make sure you don't overtrade. It's crucial that profitability is the focus. Talk to each other and be more collaborative. So I think really, really good presentations. It's now the Q&A session. So we've got the next 10 minutes or so where we can ask questions. I'm just going to try and look on the chat line. So I think first question, if I'm reading that, I think I'm going to throw to Lee. Kind of touches on what you're already talking about. But when do you anticipate a marked increase in the number of insolvencies?
It's a really, really difficult question to answer because where we are seeing the uptick, it is in that liquidation territory. And most will look more around administration or what I'd term more added value insolvency processes as in terms of looking at the uptick. Now, they are very stagnant. And the reasons for that is that rightly no one wants to see that happen. That there is a lot of collaboration, there's a lot of support in the market, and that's from one corporate to another, but also within the lender community. There's a big reluctance on lenders to not be supporting their customers. So there's a reluctance to enforce on security. They want to help with providing solutions and answers. And similarly, when you see that compulsory liquidation market is low, not many businesses are being wound up in the High Court. Now that's off the back of there being a moratorium in doing so, but it would have been reasonable to expect that there'd be an uptick in that, but we're not seeing it.
Yes.
So everybody expects that there will be an upturn in the number of insolvencies at some point in the future, but to actually define when that will happen is really tough.
I can imagine it's a hard one to answer that one. There's another question come in. I think this would be for you, Ollie, if that's okay. The war in Ukraine, and you mentioned China as well. When do you think this will impact, and what do you think the impact will be on sanctions that have been imposed for the war in Ukraine? What impact will that have on the supply chain?
Yeah, it's a good question. I mean, one of the things we're speaking to supply chain managers, supply chain directors about is not only the financial resilience of the supply chain, which we've been talking about, but also getting visibility over who you are actually dealing with. Obviously, the sanctions that have been brought in, not just by the UK government, but other Western governments as well, there is an obligation to make sure that you're not doing trade with people who are on certain sanctions lists. So we as a firm take this very, very seriously. We're constantly looking through our clients and our suppliers to make sure that we're not operating with people who are on those sanctions lists. So again, just making sure that you are complying with those sanctions obligations is really important, not just from a legal compliance perspective, but also reputationally. We're seeing a lot of businesses getting a huge amount of negative press where they are continuing to operate in certain territories, continuing to operate with third parties who have links to those on the sanctions list. So it's a really, really important part of your ongoing supply management.
There's a question coming for, I can assume because it's on green. So investing in green, what exactly does this actually mean? We talk about investing in and funding this huge investment that's ahead of us, but what actually does that mean?
Yeah, that's a very good question. It's a big one.
Yeah.
One of the things with construction is that they're responsible for about 40%, the built environment is responsible for about 40% of CO2, 56% of the UK's waste. So part of it is actually dealing with that and reducing it. So that's everything from choosing to repurpose rather than build new. That's a big, big part of it, and that is quite a shift. There are things like all the things that go into trying to reduce embodied carbon. There's an awful lot of trying to design, not over design, but actually to design for what the expected loads will need to be. There are things like trying to use new materials that have lower carbon and reducing operational carbon through the energy sources and energy use, insulation. All of those things come to make it greener. So the main takeaway is there's a whole lot of elements that you have to think about in order to be greener. But, yeah.
I mean, I'll inject on this as well, because I've seen some of my clients actually act act on this. And so I won't obviously name them, but the graphene is something where I've seen being used with concrete. And so graphene, if used with concrete, it strengthens the concrete. There's no need to have the reinforced steel. So obviously steel costs and transport of steel costs are reduced. So actually, things like that where you've strengthened where the kind of investment needs to go. But I've also seen there's a recent case study or pilot test that a company that I was involved with, where they were building a hospital, and instead of procuring on the usual basis of cost and price, they procured on carbon emission. And they went about the whole thing, so they worked very closely on the design build, working with architect right through to the finish, and they designed the cost based on lowest carbon emission. And actually the surprise was they didn't come in much more than they thought it was going to be on their cost. I mean, clearly it was higher cost, but not as much as they thought it could be. That's a good thing. And the other thing that they found was the most difficult with that project was the cultural mind shift. Because every time they started to go down the route of we're looking at 3 tenders for carbon emission, there would always be somebody that would inject saying, well, actually, it's going to cost us this, and it'd be a lot more. So I think those are a couple of examples, live examples that I've seen. But there's so many different examples of where you invest in green, because renewable materials is clearly one area. But I think as we go forward, there's going to be a lot more things and a lot more other examples out there. What we need to do is share those examples. We're in an industry which we don't share very much. We used to being dog as dog, and I think the collaborative approach that we talked about earlier, and if we can do more where we share knowledge instead of trying to take that margin, then clearly we'll all benefit, and it won't just be a few that benefit. There is a question just come in, sorry, another one. So one typical risk in construction sector is occupational health and safety around work sites. The risk has been further accentuated by COVID-19. How would you respond to that challenge? I'll throw it to you, if that's okay.
Well, how does the Environment Act respond to this? Actually, the Environment Act doesn't deal with that particular risk, but obviously the occupational health and safety issues that came with COVID-19 and then getting back, actually constructing, particularly from 2020, actually getting back on site was enormous. And I have to say, in the UK overall, in England and devolved governments, it was, I thought, really well dealt with, because we very quickly got guidance out around how to do that and how to do it safely. So I think, if anything, we can look back with some pride in terms of how well the sector dealt with that and was able to actually get back on site and safely as a result of the support we got in terms of guidance that we got on how to do that.
I'll make this the last question because I'm conscious of time. We're going up to the 1 o'clock. The last question there is, it's actually aimed at me. So, Paul, you talked about R&D not being taken by construction. Why is that? It's a really difficult question to answer, but my take on it is we still look at construction as being conventional and traditional, and we still look at it as though we don't have any men in white lab coats working on a construction site. Actually, that's quite the opposite now. We do have a lot of technology and innovation, and you only have to look at some of the buildings, particularly in London. The skyline is full of innovation. So the uptake in R&D is now growing. What you need to be doing is actually just look at what processes, as opposed to it's not always about end product. It's what processes are involved in the R&D from start to finish. And you'll find that a lot of it is in groundworks and civils and the design phase, and that can't be missed. So I would probably plug here to speak to a good advisor. Obviously BDO would be welcome to talk to you but speak to somebody that can actually help on R&D. I think on that note, we're coming to 1 o'clock, so I think you've got an extra minute of your life back. So on that note, thank you everyone for attending. I appreciate the presenters. They've all done an excellent job, and thank you for a very insightful. This is a difficult time for construction, but actually, as I said earlier, the results at the moment look good, but that's, we're yet to see what will happen in the next 2 to 3 years after those secured orders have dropped. So just the last few housekeeping points. I said we'll send out the slides. We'll send out the recordings of this presentation as well, and we've got a report that's to go out at the end of this month as well. So thank you very much, and enjoy the rest of your day.